Ladies and gentlemen, I'm very excited to be part of this amazing Green Tech Festival. I do have a bad news, but also a good news. Let me start with the bad one. We are facing a period of unprecedented uncertainty and transition. Extreme weather events are affecting many parts of the world, and the world's poorest regions are being hit the hardest. If climate change proceeds unchecked, then the risks to our society, the economy, and the financial sector will rise significantly. We must avoid that scenario under any circumstances. Tackling climate change is a global priority. And now the good news is, by acting jointly and decisively, we can give the world a chance to limit the rise of the global temperature to 1.5 Celsius degrees. The pathway to net zero emission is narrow. To succeed, we need the innovative power of each and every one of you. What is more, we need money for cutting-edge technologies enabling a sustainable future. As a central banker, money is my daily business. And I very often hear, money does make the world go around. But I think, and I know that, money can change the world too. It is clear, in order to reach net zero, a pure divestment strategy alone will not be sufficient. The pathway requires additional investment totaling an estimated amount of 350 billion euros annually over the next decade. And that's just the figure for Europe to achieve its 2030 climate goals. Globally, the figures are even more striking. To reach the net zero emission by 2050, studies show that we need an investment globally in clean energy that is more than triple the size we know. And now listen carefully, we need annually an investment of $4 trillion annually by 2030. In brief, we need more fund flowing into clean technologies. And importantly, Europe needs to show greater willingness to fund innovation. This requires deeper capital markets and more risk capital to support smart ideas from smart people like you. New technologies need to grow, to scale and to be attractive for developed and for developing countries alike. Which regions become clean technology hubs will depend not only, but crucially, on the prevailing funding ecosystem. The good news is that venture capital finance is on the rise in Germany and elsewhere in Europe. Nevertheless, there is still plenty of upside potential. It is no secret that other continents are the front runners in this respect. Global venture capital investment hit a record of $127 billion only for the first quarter of this year. Unfortunately, the US and Asia accounting for nearly 80% of this sum. Europe's catch-up potential is especially apparent at the latest stage of growth. This is when startups enter a crucial phase, when accelerating and rolling out production are of the uttermost importance. I genuinely believe that Europe needs a completely new investment culture. Experience shows that excessive caution can lead to missed opportunities. Government play a key role here. In order to mobilize more risk capital, governance needs to set the right incentives. Deeper public-private partnerships, for example, could bolster funding for technical innovation and attract a more diverse pool of investors. Germany's Future Fund, as well as the Fund Location Act, are important steps in the right direction that Berlin should gradually build on. We need to see more of that. A sustainable transformation, however, requires more than just an efficient funding ecosystem. It takes knowledgeable investors too. We need investors who have the skills to recognize high potential businesses and at the same time the patience to see them grow and prosper. Moreover, of course, we need a regulatory environment conducive to long-term investment planning. And that at least includes three things. First, what we need is an adequate carbon pricing system that will make ultimately carbon-intensive production unattractive. Second, what we need is also a common taxonomy that defines what is actually green sustainable. So in other words, we have to define what kind of activities do we think is sustainable or what kind of activities will lead us there. And the third point we need, also very important, is a mandatory reporting. Investors need to know the carbon footprint of the companies they want to invest in. In other words, we need to have more market transparency in this regard. Ladies and gentlemen, it is hard to overestimate the importance of a successful green transition. To succeed, we need all hands on deck. We need to embrace a new investment culture, and we need to foster greater collaboration between governments, businesses, the financial sector, and research. Jointly, we can pave the way for a sustainable future.
Ladies and gentlemen, thank you very much for having me remotely today here at the GREENTECH Festival. It's a great pleasure to share this moment with you. And building on what Dr. Mauderer has just said, we have a huge challenge to finance a sustainable future. It can be done. Let's tackle it. And I would like to share together with you today a few thoughts about what role private clients, wealthy private clients, but also you and me can play in this. Can finance save the world? Yes, maybe it can. And so far, the answer has been delegated for a long time to institutional investors, to asset managers, to the large asset pools of pension funds, of insurance companies. And maybe rightly so, because they do control together the largest part of global assets. Back in 2019, it was more than 50 trillion US dollars, and it has been growing since. And these few institutions have really set the agenda when it came to reporting, when it came to research, when it came to rating and resource allocation. They've been an enormous driving force in financing what we have today for a sustainable future. And some of those asset managers today are actually influencing the corporate world through the standards that they're setting, through the dialogue that they're enforcing in the corporate and institutional world. This is great now, but it may come too short just relying on the force of the institutional investors. And I believe that the private investors have been a bit the forgotten part of the equation, and the private investors can actually play an even bigger role moving forward. Why so? Because they're also a great pool of resources, of assets. Back in 2019, it was almost $40 trillion of assets held by private investors. And I will come right back to more reasons why actually we private individuals can and should play an even bigger role in financing the future. But let me start with the core, with investing. Most private clients today across the globe take care of their finances and they keep a degree of control over what is happening with their assets. They may have deposited them with financial institutions, but they instruct the banks what to do with them and they drive the direction of their transactions. And it's through those actions that flows can be generated. We all have to be mindful that buying and selling securities in the market, like equities or bonds, will not directly finance the future. But those flows set important signals. They set important signals for the value of companies, but also for the preference of investors. And in that sense, very strongly can support a transformation of the industry. It's also the private investors who can ask for transparency from their financial institutions and thereby drive the generation of information and the aggregation of information that allows to make better decisions. And sometimes, I believe we will hear today about impact investing and specific opportunities. Sometimes private clients as investors can also deploy their assets in a very targeted way, truly investing in technologies, in possibilities for the future, and thereby, at a small scale, making a real difference. But private investors are more than just deployers of capital. We are also conscious consumers. And as consumers, private clients can vote and should vote with their wallet about what are the right solutions, the right products to invest in, and which one not. Private clients are also at the same time often executives, CEOs, entrepreneurs, people who drive companies, people who build their own companies. And as such, private individuals have an enormous influence over where the direction will take us moving forward and how fast the transformation will go. Private clients are voters, and through participation in the political process and progress, we can truly change the world in which we live. We're part of the communities in which we operate, and by giving back to those communities, we can drive the S dimension. And last but not least, it's in the families. It's in that working together of parents with children, that values are discussed, are passed on, and that the next generation is brought to life for the future purposes. So bottom line is, private clients, private individuals actually play a huge role in financing the future, directly, but also indirectly through their role as society. Now, wealth management, banking, has already done a lot of things up to today and has many more challenges ahead. We have much more to do, and we should do it much faster. But we all should be mindful of what can be done already today and make full use of those capabilities. The banking sector today is looking in a different way at wealth than in the past. Wealth is not just financial wealth today and money on the account. It is also a broader, a more purpose-led view and a longer-term view on what wealth encompasses. And in the same way, risks have been redefined. Now, that might not be always known and seen in the public, but the way how risks are assessed today, including E, S, and G considerations in what we do, is completely different from what was done 10 years ago and continues to evolve at a very, very high speed. I'd say in a few years' time, there will be no investment process in a bank that will have no consideration of E, S, and G risks. Financial services companies should drive education. They should support their clients, but also their relationship managers, their own people, in being able to talk about those topics, and those efforts are underway. We've heard before transparency, and I believe transparency is absolutely key. Together with the industry, together with data that we get from the real economy about carbon intensity, about CO2, about temperature impact, we can create reportings where all of us actually see what our investment portfolios do, not just today, but also what is the transformative value of the money that we have, and we can gear our actions accordingly. And then obviously our core role is to create the right opportunities to invest and to give the conduits by which clients can express their ideas financially. There's a lot of innovation happening in this, ranging from green bonds to green ETFs, going into full designed targeted impact strategies. There's a lot happening, and I can only invite all of you to go and demand this from your financial institutions and have that conversation with your banks. And ultimately, it goes one step beyond. It's also about engaging our clients ultimately in co-creating new investment opportunities and new transformation opportunities for the future. Especially we as wealth managers globally can work with the decision makers across the globe to really drive a content agenda that goes much beyond just the managing of money. Can financial services companies play a key role in this? Yes, absolutely they can and they should. But they're not alone and they should not be alone. And at the end of the day, this works only, as we've already heard before, in a network. It works in close connection with the corporations in which we invest and that ultimately have to drive the progress down on the street. It needs politics and regulations, and I fully agree to the point of carbon pricing. Let's properly price exogenous factors, because then the market forces can unleash their full power and will help regulate the developments moving forward. But it needs also boundary conditions. And again, the politics, the regulators can set them. Let's make sure that we operate on level play fields with very clear boundaries moving forward. But it also needs academia. We need to further develop our insights, our arsenal of tools and our taxonomies, and it needs the NGOs. It needs a critical dialogue, and I'm always looking forward to an engaged dialogue with all stakeholders in this market. I do believe, together with all stakeholders, private clients and financial services can truly make a big, big difference in solving tomorrow's challenges. Let's get every day better. Let's get every day faster at this. Thank you very much.
Good afternoon, everyone. I'm ERIKA KARP, the Chief Impact Officer at Pathstone, and we serve families and institutions in driving their assets in ways that are aligned with their values. When we talk about financing the future, we have the capital to finance a better future. We have the technology. What we really need is the force of will. What we also need is imagination. Albert Einstein said that imagination is more important than knowledge, and that is the truth. We have to use our imaginations to think about an economic system, a financial system that is healthy and vibrant and inclusive and regenerative, and we can do all those things. That said, we sit in unprecedented times. To that degree, we are positioned well to move forward at an accelerating rate. And when I talk about it unprecedented, there's out there that's new. As an example, these days, the largest corporations have unprecedented power. It is concentrated power. We're talking about a handful of the world's companies that own 10% of the revenues that are being created, 10% of the job force. So that kind of unprecedented concentration also means unprecedented regulatory scrutiny. And so as we think about that, we have to think about what does it mean to be a sustainable company? We would argue that corporate sustainability is simply the same as corporate excellence. And we define that as the relentless pursuit of material progress towards a more regenerative and inclusive global economy. Now, other things right now that are unprecedented. The fact that we have social media moving things so quickly, moving transparency so quickly, that companies might as well be transparent because we are going to find out what's going on. So we need standards for disclosure of ESG factors, and we are starting to get those material factors that drive economic outcomes. Big data. There's a huge amount of information flowing out of companies through the media, and most of that data, frankly, is noise. With big data, we're going to be able to turn noise into signal. We're going to be able to get predictive insight about what's going on in the investment landscape. Another thing that's really unprecedented is the alignment of the pieces of the capital markets. The dynamics are shifting. Now we're seeing asset owners, asset managers, investment banks, exchanges, regulators, academics. We're seeing the accountants, the lawyers. We are seeing all these pieces line up in favor of transparency and sustainability. So that kind of confluence is unprecedented. We are also, as I mentioned, creating standards for disclosure by companies. All right. Right now, there's no comparability. We can't project out based on the ESG data we're getting, but we're going to be. And then finally, we're seeing what is unprecedented in terms of crisis. We have been going through one of the worst health crises the world has ever known. So we've got the health crisis, we've got the economic crisis, we've got the climate crisis. We have a crisis of confidence in the world's institutions. And again, having all that going on at the same time, unprecedented. And I would add, to solve these issues, the greatest challenges of the world, as defined by the UN Sustainable Development Goals, we need imagination. Now, I'm going to give a couple of definitions to keep us on the same page. Sustainable investing. At Pathstone, we define that as the systematic integration of the material, environmental, social, and governance factors that should be integrated into every investment process. And by the way, ESG, all right, on the one hand, it's everything. On another hand, it's nothing. And when I say that, it means that no single ESG factor is enough to base an investment decision upon. That said, we need clarity of all those key factors. And when it comes to E, S, and G, the governance, is first among equals. If a company is well governed, it is looking at key environmental and social issues. If it is not looking at those issues, it is not well governed. By definition, it's tautological. And so when we think about what has to happen, we think about corporate sustainability, we think about that being discounted into every investment process, and then we have to be honest. Now, William Shakespeare said that there is no legacy so rich as honesty. So we need to be honest about what the challenges are to sustainable and impact investing. And by the way, impact investing, here's where we think about the idea of intentionality, all right, and also measurability and additionality, which we hope is an addition to the positive social and environmental impact that we're looking for. But here's where we have to be honest. There are huge challenges that we face. We're going to, with imagination, but those challenges include the language of sustainable and impact investing, and double bottom line, and triple bottom line, and values-based investing, and socially responsible investing, whatever you want to call it. It's just investing. We need to do it with more imagination. Another issue, another challenge to be honest about, is that there are myths still around sustainable and impact investing. One is that you have underperformance, investment underperformance, to engage in ESG integration. That is simply a myth, and there are hundreds of studies that put that to rest. ESG data is critical. Another myth is that there's a breach of fiduciary duty in some way to use ESG analysis. Again, why would you not want more information than less? That's a myth. We do have a myth that the data quality is problematic. Again, we're getting better with corporate disclosure standards. And then finally, a challenge is that there is a perception, in particular on the part of the next generation, that capitalism is broken. It is broken. It's been extractive and exclusionary, and we have to fix that too. Again, we can, with imagination. And then further, we have to be honest about the Sustainable Development Goals, 17 huge aspirational goals. No poverty, no hunger, education for all, clean energy. Those are so high level that they're in and of themselves uninvestable. So we need to create pragmatic tools to get there. At Pathstone, we see everything as an issue of access to capital and to broadband, to water, to healthcare, access to those of the 17 development goals that can lead to a more healthy global economy. And as I've mentioned, we have to think laterally. We have to be creative. We have to use imagination. And another thing Einstein has said is that logic will get you from point A to point B. Imagination will take you everywhere. So for everyone here today, I wish you energy and creativity and imagination and success. And again, it has been my pleasure to say a few words today. Thank you.
Hello, everyone. I'm Joseph. I'm very happy to be here today. I'm an entrepreneur by heart. I started 4 companies myself. The last 2 got acquired for roughly $500 million. And one of them actually got awarded here many, many moons ago. The company name was Chulex. So I'm very happy to be here again and talk a little bit about financing today. Because when I ended my entrepreneurial career, I thought of having an impact, as we just heard. And I thought, maybe I focus my financing activities in areas where I could have most impact. And one of the areas that I would like to discuss with you today is SPACs. So for those of you who are not familiar with what a SPAC is, it's essentially a publicly traded shell company with a lot of capital, which is stage agnostic, that takes most likely a pre-IPO company into an IPO-ready phase. And if you look at the stats of SPACs globally, you will see that most of the SPACs are actually listed in the United States. So over 90% of the capital, and we're talking about roughly $100 billion so far, are located and listed in the United States. While when you look into companies that have an ESG impact and the listings there, you see that the majority of these companies are actually in Europe. If you look at the GDP contribution of heavy industries, heavy energy consumers, most of these companies are in Europe. So you see a natural mismatch, which speaks for the importance of having SPACs and more capital in Europe. And together with 4 friends, we actually, 4 founders, we actually committed 250 million euros of our own money, actually being dedicated into that what I think very, very important topic. If you look into the SPAC market specifically and how they perform, it's essentially a bridge from a private market into a public market. And most of these SPACs that I just talked about, most of the $100 billion in the United States and a little bit in Europe, were actually initiated and ran by finance people. And surprisingly or not so surprisingly, the performance of these SPACs and the companies is really, really bad. Why is that? Because some of them are optimized for short-term returns, which is not necessarily what drives the public markets. That's the lower line that you see that is declining constantly. These are specs that are being managed and ran by finance people. If you look in the overall spec performance across traditional IPOs, specs being ran by finance people, specs being ran by operators, and the market index, you see that specs that are being managed and ran by operators that ran companies before are financially outperforming the market pretty significantly. So it's not only a very important topic from a sustainability perspective, it's also financially hugely attractive. If you then look into the opportunities that are arising, you will see that there's a lot of capital being needed to manage that transformation. On that slide, you see a few of these opportunities highlighted. And before we talk about these opportunities, I would like to talk about the fact why we see these opportunities. And I think it's because of two megatrends. The first megatrend is digitization. Every technology, every industrial sector is being disrupted pretty heavily and pretty fundamentally through technology. And the energy space, both on the supply side and the demand side, will not be any different. The second big megatrend that we're seeing is the move away from the fossil fuel powered economy. And if you look at countries like Germany as an example, and you pull the plug from nuclear energy, which is very cheap, at least at first sight, and very reliable, and then you look at the industrial world that you have and the GDP contribution these companies have, you will very quickly realize that you got to do something, right? So that's these are the two megatrends that are accelerating one another. It's digitization and the move away from the fossil fuel powered economy. So what does this mean? You see a few of these opportunities documented on that slide. I want to highlight a few. One is the service economy and servitization in general. So what does servitization mean? This thing has a lot of different names. It's equipment as a service, pay-per-use models, industrial subscription. Most of you might know it from the car sharing economy or from streaming. You basically subscribe to a service, and instead of buying the product, the car, you subscribe to the service, which is mobility. You see this in the industrial world with printing as a service, laser cutting as a service. With my former company, Relay, we actually did a project together with Porsche where we do car manufacturing as a service, where we acquired a Porsche factory and now charging back to Porsche together with our parent company, Munich Re, for every car that is being manufactured. So that whole trend about servitization will fundamentally impact the energy industry as well, and ARR, recurring revenues, will become a very important KPI for the energy industry. Then you have bridging technologies such as carbon capturing, which are going to play a very, very important role as we do the transformation. And then for me personally, the biggest opportunity is actually in between the supply and the demand side. So we talked about Germany discontinuing nuclear energy like 10 years ago and still consuming energy the same way we consumed it before. You obviously have a big delta. And how do you address that delta? Through another source of energy. And the biggest untapped source of energy we're having is waste. We waste so much energy when we generate energy. We waste so much energy when we consume it, in the way that we process it, in the way that we produce goods. So if we focus and double down on energy efficiency, that in itself has a pretty big impact. So these are a few of the opportunities which should everybody in finance, make everybody in finance very, very excited, because it will fundamentally change the way any industry is actually being managed and ran. And then last slide that I wanted to talk about is the amount of capital which we need to make available to actually manage that transformation and manage it successfully. So we have around 130 trillion of investments needed to make that transformation. All of the specs that are currently being deployed in the market come up to, or sum it up to, like 100 billion. And only a fraction of those are actually dedicated to ESG or energy, which means we have a big delta on one side, but we also have a huge opportunity ahead of us. And if you look at the different buckets where we can deploy that money, you will also see that energy efficiency is the biggest opportunity for us in that market. So to sum it up, everyone that has an entrepreneurial background, everyone that is interested in having a real impact, both on the ESG side, but also financially, I would strongly encourage you to get going, invest in companies. I have since I sold my last company, acquired 15 companies in my PE portfolio to actually really focus on that opportunity. I do this with a economical heart and an environmental heart and try to bring this together. And for me personally, the SPAC market, specifically in Europe, is very, it's still at its very early stages and something that I'm going to personally, double down on. And with that, I'm looking forward to a hopefully good panel discussion. I wanted to thank you for your time today. Thank you very much.
Perfect. So, great to have you here. And we have Erika and Philipp on the screen. Thank you for your insights, well, all four of you, for your keynotes. And actually, my first question will be to you, Sabine. It is, well, Germany has always been famous for being, well, the tag made in Germany. In the past couple of years, it's kind of transformed towards something more like late in Germany. What would you, or why would actually investors invest in Germany?
Well, as a central banker, I cannot give you any advice how to invest your money. At the same time, it's clear. I mean, you see the German and the European ambition. We want to get carbon neutral by 2045. So, and the biggest majority of the society backs this goal. So, and at the same time, our wealth relies on traditional industry, as you said, right? So it is clear what Germany and Europe needs is innovation, innovation, and innovation. So getting back to your question, the why, I would ask myself, well, where is my innovation needed and where is it wanted? And this is definitely here, right?
Question to you, Josef. Being an entrepreneur, what do you think about these times? Is it a good time to invest? Is it a good time to invest in Germany?
Well, it's always a good time to invest in yourself, first of all, right? But I think there was never a better time to start a business because of these two megatrends that we're seeing and the importance of it and the amount of capital being made available. So, for me personally, I do this for 20 years now. Everywhere I walk, there is opportunity, right? I think innovation is key. I would agree with it. But I think execution is more important, right? The best innovation doesn't really help if you don't, get grip on the street, and if you really start executing. But for me personally, with these two changes that we just discussed, digitization and the move away from the fossil fuel-powered economy, every market will change. So I personally think there was never a better time.
Maybe I just jump in because I think this is very important what you said. Innovation is one key, but you have to stay here and to implement it and to get the money for it. And this is what Germany has identified. And just one example, we have set up funds and we have at the same time announced that our very famous promotional lending bank, KfW, will become a transitional bank. So I think we identified this and I'm pretty sure we will work on that.
So once again, speaking about investment, Erika, question to you. What are your thoughts on, well, passive and actively investing?
Yeah, I think that to do impact and sustainable investing, it really is, it's an active function. And it's because when we talk about ESG data, one data point is simply a starting point for more inquiry. And so when it comes to passive, you have a problem about systemic flaws built into the system. Because if you're starting with bad data, and then you have the data aggregators, and then you have the rating systems, and then you have indices built off of them, and then you have ETFs built off of indices. Well, there are flaws all along the way. So when it comes to sustainability and impact, you're really not getting what you need to get. And a critical part of investing, sustainable and impact investing, I think is that engagement. Corporate dialogue and engagement, so we can make progress happen in a really constructive way. And by the way, I just have to make a comment, because we were just talking about innovation and execution, right? And so I'm reminded of my favorite business strategist, also a Chinese warrior, Sun Tzu. And Sun Tzu said that strategy is the longest path to victory. Tactics are the noise before defeat. So we need to have both the strategy and the tactics, and together that groundswell of demand for more conscious kind of investing. So active.
Sounds good. Philipp, question to you. Speaking about megatrends, what megatrends do you actually see in the future, and what is their role in sustainability?
We talked already about some of them, didn't we? About digitalization. I fully agree. The digital transformation of our society is creating unprecedented opportunities. Also some challenges along the way on the E side, but also on the S and on the G side. We talked about the sustainability, the fuel transition that is happening, the energy transition. I see a few more and even more fundamental elements, like the overall growth of the planet. We'll be approaching maybe 10 billion inhabitants on planet Earth, sometimes, depending on the statistics, by 2050 and 2060. The challenges associated to that are huge. How to feed a world that is growing so fast with healthy calories produced in an ecologically meaningful way. How to drive clean water, clean air for so much population. So I think the fundamental driver of growth is there. And then there are other topics like healthcare or biotech, which almost in the shadow of technology are bypassing, and where the development is even faster than Moore's law on the microchip side, and which is going to give us a plethora of opportunities. But on the other side, also many more challenges, talking about equality, access to healthcare, about individual rights, and even moral questions. I think in this web of megatrends, it's super important, even more important, to consciously invest and to really guide the investment streams in a direction to drive a transformation, to drive the values that the investor wants to put in. And so I think the topic of sustainability, of creating transparency, of making conscious choices through different vehicles is going to be extremely important for all the decades to come.
Josef, we've talked about Germany's role being known for manufacturing amazing cars, great machines. Where do you actually see Germany in the future?
Well, what I hope Germany, becomes is a service economy, because what we build our at least perceived wealth on is machines, and what we did is we optimized the machines that others used to build products, which then delivered services. So if you follow that logical chain, you're at the very beginning of a value chain. And then you consider a trend that is going on that is called vertical integration, which means somebody owns a market and vertically integrates every piece that is being needed to deliver the service, right? Streaming economy as an example, to make this simple, hires the actors, acquires companies that do the production, makes the marketing, the distribution, and provides the platform, right? So no cinemas, no studios, no nothing. One platform to own it all. You look into the manufacturing market, you see laser cutting as a service, where you basically have service centers that have machines, cut the part, buy the material, and have one part, and then deliver that service to the customer. So if Germany doesn't wake up, you become a wreck wheel in somebody else's clockwork, right? But the margin and the value is within the outcome, the service that is being produced, because that's what you subscribe to. So if we don't move up the value chain, then we have a significant problem from a GDP's perspective. So where do I see Germany? Hopefully as somebody who has the machines, the knowledge, and the domain expertise, somebody who is going to vertically integrate the service offerings in the market that we're playing today.
So do you think it already made click in Germany? Do we know that we need to ramp up?
Some did, others didn't. But if you look into this historically, you see over the last 5,000 years that you always had these waves, right? So China, as an example, 5,000 years ago, was the biggest owner of ships and had the biggest trading fleet. Then they became too rich. They screwed it up. UK and the Netherlands came, built ships, fought against the Chinese, took the wealth. Germany is I think we're too fat, right? And we don't necessarily understand the importance of change, but it's very natural because people like to go down the route of least resistance and we hate change. And I think people just learn through pain.
Sabine, this brings me to a question to you. Making it bigger, not only Germany, speaking about Europe as well, what actions are Germany and Europe taking in the green tech field?
I think maybe something what you Joseph, just pointed out, I think I would love to tackle on that, because what I think is that we have always in Europe, especially in Germany, known for being risk averse. No, risk was not in our DNA. This has historical reasons and other reasons I don't want to go into detail. But what we also see now is people know or understand that it doesn't make sense anymore to put all your money on your saving account. And I'm, as a central banker, know that see the yield curve. And so what we actually see in Germany is a trend that especially young, well-educated people below 40 start to do investment on capital market, right? And so, getting back to Joseph, I think what we see definitely is that people accept a certain rise of risk, right? And people have understood that there's no alternative to capital market if you want to invest your money, especially on the long term. And by that, you have to learn that capital market is about risk sharing, right? And I think, going back to you, I think so many well-educated people have understood that, and more are coming over the next decade, I'm pretty sure.
You're sure? I'm pretty sure as well, because the past year has proved that we need to change our thinking, and I think a big impact has happened in the past 16 months. ERIKA, this brings me to a question to you. Speaking about Pathstone, where is the intersection between diversity and sustainability?
Oh, that's one of my favorite questions. I guess what I would say is that diversity is inextricably linked with sustainability. And that goes back to the fact that we need imagination and creativity, right? Diversity leads to the kind of thinking, lateral thinking, where there's respect and there's engagement and there's inclusion, right? And so when we think of people that really embrace success of others, however it's done, this is really positive. We have an enormous amount of empirical information that shows that diverse groups make better decisions, period. The issue is that the process itself can be a little bit messy. So diverse groups are going to have more apparent conflict inside. Diverse groups sometimes look less functional from the outside, right? That said, we know, again, better decisions, more lateral thinking, more creativity, more productivity, more inclusion. Diversity, frankly, is beautiful in everything we do. And if we're going to get to the goals that we have in place, we must have a diverse, creative, inclusive, respectful workforce. So, it's inextricably linked.
Can't be divided. It comes along with each other. Thank you very much, ERIKA. Final question to you, Philipp, I'm sorry. Do you think, what's your perception, has the mind about being ready for risk and being ready to invest changed in the past 16 months during the pandemic?
Maybe yes, but I look at it rather from a longer term perspective. I think, and I look rather into the future and say, how should it change? And I think no matter where the risk appetite historically have been in certain markets, whether it has been high risk or low risk, I believe we need to find a way to finance the future and to take the associated risks in the years to come. And for that, I think financial services can play a key role in offering that marketplace and offering also that risk transformation in helping to make difficult business risks and strong risks accessible to clients with lower risk tolerance by properly bringing things together, by packaging them, by explaining them. And I think that's really something that we as a society should master. And with that, maybe we will be getting also, let's say, the low risk investors, we've talked about them before, on the table to actively play a role in financing our future developments.
All right, thank you very much, Philipp. And thank you to all my panelists. Unfortunately, we are already at the end. A big round of applause, please, for my guests, Dr. SABINE MAUDERER, ERIKA KARP, PHILIPP RICKENBACHER, and JOSEF BRUNNER. Thank you.